Today we look at economic value added statements. Economic value added, EVA. And when we talk about EVA, we are simply talking about the residual income. Now, residual income, we said it is the income minus the cost of capital. The income minus the cost of capital. Now, EVA says that this income and the cost of capital, they have not been arrived at in the proper way. And therefore, it recommends what we call accounting adjustments. And the accounting adjustments are several. One is what we call non-cash expenses. Non-cash expenses include things such as depreciation, provision for depreciation. In the normal way of accounting, they are usually subtracted. But EVA says no, you should add them back. So when you come across non-cash expense, they should be added back. Number two, there is something called depreciation. As you know, in the normal accounting, depreciation uses or is computed as cost you divide by the useful life. And at the end of the useful life, like if you look at what we were doing in our last lesson, if the lives were 4 years, by the end of the 4th year, you have fully charged this depreciation. So when you are going to the 5th year, there is no depreciation amount to be charged. But EVA says there is a possibility that when you close to the 5th year, this asset will still be useful in the organization. And as such, then, you need to recognize the benefit that that asset is giving and the cost of it. But now there is no cost because you have fully charged the depreciation. So EVA will say you need to add back this cost depreciation, and now you charge depreciation based on economic. So you add back the cost depreciation, you less what we call the economic depreciation. Economic over form. So when we talk of economic over form, we are looking at the usefulness of a product or of a machine. So that is the one that should be used. There is something else called interest on debt. Now, interest is a compensation that is given to the debt providers. But EVA says there are also other people who provide capital who are known as equity. And equity, they are paid dividends. They are paid dividends, the equity providers. But in the normal financial accounting, interest inatolewa huko juu. Dividend inapatikana huku chini after tax. So EVA says that kama ucompensate kila mtu, debt na equity. Na kama haiwezekani kila mtu, then no one should be compensated. So the way to go about is that if they had charged interest, you add it back, obviously net of tax. You add it back net of tax. The other thing is something we call advertising and marketing costs. Now, according to the normal accounting, we take them as current expenses. meaning they are incurred in this period and we stand not to get any benefit from them. For example, as church and consultants, when we place an advert, that advert, the cost should be charged in our income statement for this semester only. It assumes, therefore, we will not get a student next semester who saw that advert today, which is not true. There's a possibility of a person who has seen the advert today and will join us maybe next year. So if that is the case, then this one should be returned back. Adverts, we return them back. Then you amortize over the usefulness. You amortize over the usefulness of that amount, and you work with it that way. The same argument is forwarded for research. Research, again, the normal accounting subtracts it as a current expense. But now we are saying it should be added back, and then you capitalize it. After you capitalize it as an intangible asset, you will amortize over the period that you think that cost of research will benefit you. That cost of research will benefit you. Something else is called goodwill. The same thing. You know very well from your normal accounting, once goodwill has been recognized, we almost immediately write it off because we do not have a good method that is used to compute goodwill. When you write it off, then you are telling us that money or that goodwill will not benefit us going to the future. But that is not true. There will be benefits. So again, Eva says, return back. Then you capitalize and then you amortize. Those are some of the expenses that, and maybe another one before I forget is leases. We have what we call the capital lease and what we call the operating lease, the short term and the long term. So for the normal accounting, the short term is treated as a current expense. But now Eva says you return back. So these are the accounting adjustments that should be made to the profit here and should be made to the capital so that now we charge cost of capital appropriately. Haya, sasa, I would like you to look at a question that was tested in December 2009. Get to your past papers. December 2009, kuna question 2B hapo. Question 2B. Just look at it. As I designed the statement. Read on your own. That's the design. When you have it that way, if you are finished to design, say my yes. Maliza kuchora hiyo table, sema finished ama useme yes. Okay, we are finished. So, what you need to do, number one, is always to bring what we call conventional income. Conventional income. Now, the conventional income, it is any profit, any figure in the income statement that has the word profit. That has the word profit. That is the one that we use. Any. But bora where you have started, you know what has been subtracted and what has not been subtracted. So in our statement here, we are going to use the profit before tax and interest. That's the one that we are going to use. A has 28.5. 28.5. B has let me confirm with the original question whether that is blank. Doubt whether it is blank. 2009. Inakaa blank but should not be blank. Utaipata namna hii, naona hata hii kwangu yenye nimeprint is the same. Na hii ni 9.5. Na toto yote ni 76. So just find out, Just find out. That is a typo. Find out what must this be so that when you add this plus this plus this minus this, they are giving us 76. So what must this be? Because when you add the four of them, they should give us 76. So find out what that must be. Oh, good, 28. That figure is the one that is missing there. It should be there. Should be there. Higher. So once you have done that, you now bring the accounting adjustments. The accounting adjustments. Now, the accounting adjustments, there is one that I did not mention, and it is rarely mentioned, but you are expected to know. Anything that is in the head office should be shared. If there is anything in the head office, you should share to the departments. So in this case, we start with the head office loss. This 9.5, and we make it positive there so that it goes to 0. Now, some questions will be very clear on how to share the head office. They will be very clear. They will have given you the methodology. But if the question is quiet, we always use revenue. We always use revenue. Like now here, I don't think the question is speaking on how to share this head office. So what you do, hii sales, hii sales, hata sales ya department C inakaa iko na makosa, inaonekana kama 1.1 but should be 1159. Can you confirm that 408.5 plus 316 plus 1159 is equal to 1883.5? Confirm. So it's 1159. Good. So if it is 1159, what you shall do to get the share, me, I will not write the workings. Sina space. You can write wewe mwenyewe. So for A, utasema ni 408.5. You divide by the total. The total ni 1883.5 times 9.5. So give me that answer to, you can write it wherever. If you have space, unaweza andika hapa ama huko chini. Give me to 1 decimal. Give me the figure to 1 decimal. Or you want us to use 2 decimals? Sawa. 2.06. So unaiandika hapa negative 2.06. Negative 2.06. Haya. So let's go to the next one. Let's use 2 decimals. I think that is what I've captured first. 2.06. Haya. The next one is utachukua 316 out of 1883.5 times 9.5. Again, give me to 2 decimals. $1.59. The last one, it is 1159 out of 1883.5 times 9.5. But the best way to handle that, because you have been rounding, it is to say 9.5 minus 2.06 minus 1.59. Ndio tupate the exact figure that will make them to add back to 9.5. So tell me how much that is. So 5.85. Yeah. 5.85. The other adjustments that now you require, unaenda hapo kwa additional information. Unapata that division A spent 10.5 on research. So tumesema research and development should be added back. So kuja hapa useme research and development. Or let me just call them research costs. So research costs was only spent in department A, 10.5. And then we let hapa kwa the total, 10.5. So hiyo iko tu sawa hivyo. The next one is goodwill amounting to 90 and 113 was amortized during the year for divisions B and C. So goodwill amortized. It should be added back. So in division B, it is 90. So tuweke 90 here. Division C, it is 113.5. So give me the total of the two, this plus this. 203.5. So hiyo unaweka hapa 203.5. Next is advertisement expenditure to that was spent by B. So advertisement costs. Advertisement costs. That should also be added back of 11.5. And it is in department B. 11.5. So if it is 11.5, tunairedisha hapa 11.5. Next is head office liabilities and net to be shared, or they had said the assets and liabilities will be shared equally. Okay, so the summary of interests paid and received is given there. Now that summary of the interest is not going to affect us. It's not going to affect us because what we have used here is the profit before. Ukiangalia, it is the profit before interest and tax. It's the profit before interest and tax. So it's not going to affect us. Lakini kama tulikuwa tumetumia profit after tax, kama tungekuwa tumeanza hapa na profit after tax, we would have added the interest back. We should have added. Then, now that we also have used the before tax, we should charge tax here. But this question has not mentioned to us about tax. It has not mentioned to us about tax. Yeah, so it's good you take note of those two things. That now that tumeanza na profit before interest, we are not going to add back those interests because they have not been subtracted. But kama tungeanza na profit after, tungeiadd. Number two, now that hii ni profit before tax, we should charge tax here. But this question has not mentioned to us how to charge tax, so we leave it that way. So with that now, you come and get what we call revised income. Revised income. Revised income. So revised income, this is what some people will call NOPAT. It is this minus this plus this. Niambie inakuja ngapi hapa? That is 6.94. Next. $46.91. Next. $136.65. So this one obviously is 0.
A question.
Yes, Patricia.
Division B.
Uh-huh.
We are taking 28, we are subtracting 1.59. Are we still adding 90 and 11.5?
Yes, by the way, hata sijaangalia hiyo nimeandika tu. Yes.
Then that can't be the answer.
What is the answer? 120.
127.91.
Basi kwa nimeangalia. So the next one, is it okay? Division C?
Yes, it is.
Give me the next one. Yeah, 301.5. $301.5. Okay. So from there now, you bring conventional. When you hear of the word conventional, conventional is just the normal. Kitu conventional ni kitu ya kawaida. Yeah, so the normal way. So ile conventional capital, it is the net of current liabilities. Na ndio hii unaona imepeanwa hapo. A wako na 135.5. B wako na 119.5. C wako na 116. Head office wako na 16. Na total ni 387. So you now bring the accounting adjustments. The accounting adjustments, as I told you, the first one is the head office. So here, the head office has some assets, the head office assets. So this 16, we subtract it. And the question has already informed us that we are doing equally. So sasa hii utadivide to, utasema 16 divided by 3. So we can take 5.33 here. 5.33. So the last one should be 5.34. So that they add back. Three, 4, so that they add back. What next is these adjustments. And these adjustments that we have made in the profit here, they also come here, but now you simply check which one would go to the balance sheet. So kwa hii tumesema all these things should be capitalized. So all of them will come back here. All of them will come. All of them will come. So tuko na research costs that we have said we add back and amortize. So it is part of an asset. So hapa itakuwa asset ya A, alafu ikuwe asset huku to the company. Then goodwill amortized. Goodwill amortized. We have 90 in B. We have 113. And we have 203.5. 203.5. Let me see whether there was accumulated, because kama kuna accumulated unastahili kurudisha yote. Hakuna accumulated. Haya. Then kuna advertisement costs. Advertisement costs is 11.5 here and 11.5. So with this, we get revised capital. Revised capital. So we add them back. Tuanze hapa. $151.33. Next. $226.33. Next.
A question. Revised capital, we are adding all these figures from conventional capital downwards alone, or we will add the revised income also?
Alone.
Okay.
We are now in C. I'm waiting for the figure of C. Send your figure. You know me, I tend to move with the one that has come first. So give me your figures all. So give me the total now, uko mwisho. To 64.2. The next thing is cost of capital. Cost of capital. So cost of capital, it is the rate, the interest rate. Imetajwa wapi?
Excuse me.
Yes, Patricia.
Before you go far, the last addition, 387, 10.5, 203.5, 11.5 is 612.5.
Yeah, I suggest you also be sending the figures, Yeah, set the figures also so that you're able to compare. Then the figure also. 6.
Mwalimu, data.
My suggestion to this problem is, kila mtu atume yake. Kisha atuma, when I see there are differences, I'm able to pick. But kama ni mtu mmoja ametuma, I move with that. Utapata tunaweza songa na the wrong figure. So Kaidre, send your figure. Usione mwenzako ametuma koje. Haya. Patricia, send that figure you are talking about. Good. 612.5. Good. So I think now we are at par. Any other concern? Or I also need to confirm. We are adding 387.0 plus 10.5 plus 203.5 plus 11.5. Yes, hiyo iko sawa. 116 plus 5.34 plus 113.5 equals. Hiyo iko sawa. 119.5 plus 5.33 plus 90 plus 11.5 iko sawa. 135.5 plus 5.33 plus 10.5. Yeah, I think now we are okay. Any question? So if we are good, let's proceed to the next step. The next step, I was saying, nilikuwa natafuta rate of, nimeiona hapa kwa hii table. I was expecting it in a different place. So, utasema, maybe if I wrote the formula here, it is the rate times revised capital. Let me just write it that way so that this is a formula you can use in any other question, as opposed to writing 12. So what I expect you now to do is to give me 12%. Na sasa hii usiround. Are you able to see there now, Patricia? Sasa nitafutie 12% ya hii. 12% of 151.33. Yeah, at least I have 3 figures. Those ones. And they all agree. 18.1596. Let's go to the next. $27. These 2 figures that are in agreement. 27.15. 1596. The next. Uh-huh. 28.1808. This one obviously is 0. Next. $73.5. So the last one is economic value added. Economic value added. So this one itaandika workings. It is now 36.94 minus 18.1596. Yeah, so the same case, utakuja hapa useme 127.91 minus 27.1596, 136.65 minus 28.1808, and 301 minus 73.5. So that is the end of the statement. Tutachora line hapo. That is the end of the statement. Now, on your own, I would like you to attempt May 2021 question 5. May 2021 question 5. May 2021, question 5, very similar to this one. I want to look at another question. Go to May 2015, question 5B. May 2015, question 5B. May 2015, question 5B. It is also on EVA statement. Once you are there, I suggest you read on your own. After you have read, you design have the details. The question has the year 2013 and 2014. Mariza, sema finished so that we handle the question. Haya, so naona tumemaliza. Now, when you read this question, you can see hapo kwa income statement kuna actually three figures that have the word profit. Ya kwanza ni profit before tax. You can start with that. There is also profit for the period. You can also start with that. And the third one is retained earnings. You can also start with that. That's what I was saying, that when you have a variety, bora ujue where you have begun, which item has been subtracted so that you add, and which one has not been subtracted so that you don't add. Yeah. So for us, I want us to begin with we could also, if you start with the profit before tax, it will just be double work, because tutakuja kutoa hiyo tax, like I said, unaona hapa wamepeana tax. So I want us to start with the profit for the period. So we are going to say conventional income or profit. In the year 2013, it is 67. It is 67. And the other year, it is 82. So with that, we now make adjustments. Accounting adjustments. So the accounting adjustments, when you peruse this information, number one, you can see there is number two, there is non-capitalized leases that should be added. So non-capitalized leases, that should be added. We are told it is 16 in each year. So 16 here and 16. Next item that you can see is goodwill. Naona goodwill hapo kwa information 3. Goodwill. So goodwill should be added back. And we are told it is 5 in each year. It is 5. Ukikibia hapo chini, number 3 is talking of the cost. Number 4 and number 5 and number 6, number 7, they're not affecting us. But number 8, it is talking of the depreciation. And they are saying the economic depreciation amounted to 40 million in 2013 and 45 million in 2014. The amounts were equal to the depreciation used for tax purposes and depreciation charged in the income statements. What that means is what I told you earlier is called cost depreciation and economic depreciation. It is the same in this question. That's why they are saying what was used for tax purposes is the one that was used here. So if it is the same, then you don't make any adjustment. If it is the same, you don't make an adjustment. But if they are different, you make the adjustments.
Please pardon that point.
Okay, just a minute.
Then about leases, I thought we are taking them to, they are affecting capital and not the profit.
Unajua kuna zile zinaitangwa operating lease na ile inaitwa nini? The finance or the capital. Sorry. So the operating lease, it is the lease that you use the asset for 1 year. And there is no chance that you will finally become the owner. Yeah. The finance lease or the capital lease, it is where you use the asset for more than 1 year. And there is a very high likelihood that you will become the owner. Actually, in financial reporting, they advise when you're dealing with the capital of the finance lease, the person who has hired the lessor recognizes it. No, the lessor, the lessee recognizes it as an asset in their books. So it is already a capital asset if you're using capital lease. It's already a part of PPE. Let me use it that way. It's already part of PPE on non-current assets. So hiyo haina shida. Ile tuko na shida nayo ni ile iko current. Now kama ni current, you treat it as an expense that is charged the income statement. So when you want to rectify, it must then be returned back in the income statement. So hiyo ni mambo ya leases. Is that okay, Bernadette?
Yes, I get it. I get
Good.
it now.
Now, you had also asked about umeuliza nini ingine? Or depreciation. I am saying this. You can be told that the cost depreciation for this year was 40, but the economic depreciation was considered to be 28. Can be given something like that. So this cost depreciation ndio inatumika in the conventional hii. Conventional nilisema ni FR ya kawaida, venye tunatengeneza statements za kawaida kwa FR. Hiyo ndio conventional. So in the conventional, washatoa hii as an expense. So IVA says you should add back the 40, it should be added, and you should less now the economic one. That's what should happen. But sasa kwa hii swali wanasema the cost is the same as the economic. So if they are the same, you don't have to show the transaction because the net effect is zero.
Okay, I get it now. I see.
Aya, so tulikuwa kwa number 8. Interest payable amounts to 6 million. So if interest payable is 6 million, na hii tumedeal nayo, unaona tumechukua the profit after tax. So if we have taken profit after tax, that means already washatoa interest. Washatoa interest because interest kwanza huwa inatolewa ndio itupatie to what we call the tax shield. So interest ishatolewa, so we must return it back. So net interest. When I talk of net interest, I mean we are going to add net of tax. We are going to add net of tax. So what will happen? Utachukua hiyo interest 6. That interest 6 times tax rate tulikuwa tumeambiwa kwa information gani? You know, tax rate information 7, 30%. So 'Give me that amount. $4.2. Sasa hiyo ndio tunarudisha hapa. $4.2. Aya. So the other one is non-cash expenses. So the non-cash expense is we are told is 12 for each year. Hakuna ingine. So with that, we get the revised income. So you are getting 104.2. 104.2. The next one. Oh, 119.2. From there now, you bring the conventional capital. The conventional capital. So the conventional capital is capital employed. And we always use the opening balances. So the opening balance for 2013 is the one in information 1, 279. 279. That's the opening balance that was in 2013. Then the opening balance in 2014 is the closing in 2013, 340. The closing in 2014 is the we do now the accounting adjustments. The accounting adjustments. So the accounting adjustments, nilikwambia unaangalia tu hizi. So the first one is leases. So leases must come in. Non-capitalized leases. Because tunataka kuifanya part of assets. So hii 16 na hii 16. Then kuna goodwill. Goodwill should come in. Na unaona hapa kwa information na 3. Wanasema the goodwill before 2013 was 45. So they brought down. So you are supposed now to add the current one that you have charged. So you should charge 50. Rather, you should bring back 50. Unaleta hiyo walikuwa wametoa kitabo plus sasa hii. Then you do the same for the next year. E50 plus 5. So unaleta hiyo 55. Haya. This interest does not go to be capitalized. So interest haitafika hapa. Even non-cash, we don't capitalize them. Non-cash, we don't capitalize them. They are already capitalized. We don't capitalize. So sasa, that's all. So we get the revised capital. So give me the revised capital for, then we shall have the cost of capital. The cost of capital. Then we have the economic value added. Naiweka hivyo ndio tufanye workings. Kwa sasa hii ni composite, eh? So that will be the end of the statement, so that you are able to do the workings down there. So nipatie hii ya the first year. $345. Hiyo ingine $411. Now for the cost of capital, this one is what? Is what we call the composite. So composite meaning we have more than one sources of capital. So down there in our workings, we need to remind ourselves that WACC is equal to WEKE plus WDKD 1 minus T. That's how you compute the higher. So if that is the case, let's come to the year 2013. In 2013, we are told, according to information 6, the capital structure is 50-50. So this will be 0.5 times the cost of equity in 2013. In 2013, it is mentioned in information what? Or information 5. It is 16% plus 0.5 times the cost of debt. The cost of debt is mentioned in information 4 is 10 times 1 minus 0.3. $11.5. Let it be confirmed. Okay, confirmed. Let's go to 2014. 0.5 times 2014 wako na 18 plus 0.5 times the cost of debt is 10%. $12.5. So cost of capital. So cost of capital in 2013, it will now be 11.5% of 345. That 9.675. Sasa hiyo ndio utaleta hapa. That 9.675. In 2014, it is 12.5% times 411. Yeah, 51.375. So now get EVA. Get EVA. EVA, it is the what? It is these revised. If you call this A, and this one you call it B, then this is A minus B. Yeah.
Question.
Mm-hmm.
The previous question we did A minus cost of capital.
Thank you. That's exactly how it should be. Thank you. So the first one is 64.525. Confirm. Good. Let's go to the next. $67.825. Yeah, so there are very many questions that you'll come across under these three areas. As I told you, return on investment, residual income, and EVA is almost in every paper. So look for them and that to be good. So we are going to stop there for now. When we meet next, we should start a new area. I think I sent you all these notes. So make sure you read the theory. Make sure you read the theory because you may not have a lot of time to go through it. So now we will be looking at chapter 10. Thank you very much. Good night.